What if a small piece of plastic could give you access to almost unlimited purchasing power? With a simple swipe, you can buy groceries, clothes, even a car. It feels effortless. But this tiny card has transformed the global economy. How do we go from cash and coins to a world dominated by instant credit? Today, we uncover the hidden history of credit cards and explore how they quietly took over the way the world spends money. Let's dive in. The birth of the credit card. The story of credit cards begins in the 1950s with the diner's club card. Imagine being a businessman in 1949, dining at a restaurant, and suddenly realizing your wallet is missing. Embarrassed but inspired, Frank McNamara envisioned a simple solution, a card that allowed diners to pay without cash immediately. In 1950, the diner's club card was launched, accepted at a few New York City restaurants. Initially, it was a symbol of convenience and social status, primarily used by businessmen and socialites. Few realized that this simple innovation would eventually revolutionize the financial landscape. The Diners Club's success caught the attention of banks. By 1958, Bank of America introduced the Bank AmeriCard, which later evolved into Visa. Competitors like MasterCard, now MasterCard, followed suit. These early cards expanded beyond dining, allowing consumers to make purchases at a growing network of merchants. American Express carved a niche with premium offerings, while Discover focused on cashback and rewards, cementing a system that continues to dominate today. Credit cards were more than convenience. They became aspirational. Owning one implied sophistication and trustworthiness, and it subtly changed spending behavior, encouraging consumers to think in terms of credit and deferred payment rather than cash on hand. How credit cards work behind the scenes. Using a credit card may seem simple, but a sophisticated system operates in the background. When you swipe or insert a card, information embedded in the magnetic strip or chip, including card number, expiration date, and transaction amount, is sent to the merchant's bank, known as the acquiring bank. That bank contacts the card network, such as Visa or MasterCard, which then reaches your issuing bank. The issuing bank checks for available credit and potential red flags, approving or declining the transaction. This process takes only a few seconds but involves multiple layers of communication and verification to ensure accuracy and security. Merchants pay a small fee for processing called the merchant discount rate, which varies based on agreements and card types. Despite these costs, most retailers accept cards because they increase sales, encourage larger purchases, and offer convenience to customers. Every time you use your card, a complex financial dance occurs behind the scenes to make your purchase seamless. Even the smallest transactions rely on this system. From buying a coffee to purchasing a laptop, each swipe triggers an instantaneous chain of approvals and data verification, which ensures both security and trust in the financial ecosystem. The credit card boom of the 1960s and 1970s. The success of Bank AmeriCard and the Diners Club inspired a rapid expansion in credit card use. The 1960s and 1970s saw an explosion in credit card adoption as Americans embraced the convenience of buying goods and paying later. Credit cards were no longer just a luxury. They became a symbol of financial freedom and status. Consumers began using cards for cars, vacations, electronics, and homes, opening doors to opportunities previously out of reach. This shift fueled economic growth, encouraged consumer spending, and accelerated the development of a credit-driven society. At the same time, the rise of marketing and advertising highlighted the benefits of instant access to goods, making credit cards synonymous with modern living. As credit cards became mainstream, the financial industry also created tools to manage and track this new form of debt. Billing statements, minimum payments, and revolving credit became standard practices, shaping a system that balanced convenience with responsibility, though not everyone understood the implications immediately. Buy now, pay later, the psychological allure. Credit cards introduced a revolutionary idea of buy now, pay later, and this concept fundamentally changed how people think about money. No longer were purchases constrained by immediate cash availability. Instead, consumers could access products instantly and defer payment over weeks or months. This shift encouraged instant gratification. Marketing strategies emphasized ease, status, and convenience, creating an environment where spending felt effortless. Cards became a tool not just for transactions, but for expressing identity and social standing. Owning a credit card implied sophistication, access, and opportunity. With this new freedom came the danger of overspending. Consumers were tempted to purchase items beyond their immediate means, slowly increasing balances, while fully realizing the long-term financial impact. The psychological power of deferred payments created a subtle, yet strong incentive to spend more. Additionally, reward programs like cashback and points further reinforce this behavior, making spending feel rewarding in multiple ways. The dark side of credit: debt and interest. The convenience of credit cards came at a cost. Interest rates often exceeded 20%, and missing payments led to additional fees that compounded debt rapidly. Many consumers fell into cycles of revolving debt, struggling to pay off balances while interest accumulated. Credit card debt became a major societal concern, affecting families, personal finances, and even the broader economy. While the system enabled greater access to goods and fueled economic growth, it also contributed to financial stress. Consumers often underestimated the true cost of borrowing, creating a double-edged sword of convenience and potential financial harm. The culture around credit cards also reinforced spending beyond means. Promotions, flexible limits, and rewards often led consumers to ignore budgets, making high balances feel normal. This normalization of debt has had lasting consequences on household financial behavior worldwide. Credit card security and fraud. As card usage expanded, so did opportunities for fraud. Criminals developed increasingly sophisticated methods to steal card information, from cloning magnetic strips to hacking online accounts. In response, the industry developed new security measures. Signature panels, holograms, and later EMV chips with pins significantly reduced counterfeit fraud. However, the rise of digital payments brought new threats, including account takeovers and online scams. The evolution of security has been a constant race between technological advancements and fraudsters seeking to exploit vulnerabilities. Cardholders also became part of the security ecosystem. Monitoring statements, using alerts, and understanding secure practices are critical habits. These measures, combined with industry protections, continue to safeguard billions of daily transactions worldwide. Technology and the future of payments. Credit cards have continually evolved alongside technology, transforming the way we pay and manage money. Contactless payments and digital wallets, such as Apple Pay and Google Pay, now allow users to complete transactions without ever touching a physical card. This convenience extends to mobile apps that track spending in real time, integrating rewards, budgets, and alerts, giving consumers unprecedented control over their finances. These tools allow users to see exactly how much they spend, receive notifications for upcoming payments, and even optimize spending to earn cashback or points. Meanwhile, cryptocurrencies and blockchain technology are introducing entirely new methods for secure, decentralized transactions. Virtual currencies can operate independently of traditional banking systems, allowing seamless global payments that are fast, encrypted, and less reliant on intermediaries. Online gaming platforms and the emerging metaverse are already experimenting with integrated digital currencies, where purchases, assets, and experiences can be traded almost instantaneously across borders. Despite these advancements, the fundamentals of credit, debt management, interest awareness, and responsible usage remain critical. Technology may simplify payments and make money more fluid, but financial discipline is still necessary to avoid overspending and high-interest obligations. As payments become faster, more global, and increasingly automated, consumers must balance convenience with responsibility. The way we pay and perceive money continues to evolve, blending digital efficiency with a need for careful planning and informed financial decisions. The legacy of credit cards. Credit cards have transformed everyday life. They enable convenience, access, and immediate purchasing power. They fuel economic growth, provide rewards and perks, and have become symbols of status. Yet they also contribute to a culture of instant gratification and rising personal debt. Understanding their mechanics, risks, and benefits is essential. Consumers must educate themselves about terms, interest rates, fees, and timely payments to use credit cards responsibly. Proper management can transform a potentially harmful tool into a powerful asset for financial well-being. Credit cards also reshape global commerce. International transactions, travel, and cross-border business rely heavily on this system, making them indispensable tools for modern financial life. Credit cards are more than plastic. They are a financial revolution that reshaped spending habits and global commerce. They offer convenience, access, and opportunities, but carry risks that must be respected. By staying informed, tracking balances, and using credit responsibly, consumers can harness the benefits while minimizing debt and stress. If this video helped you understand the hidden history and impact of credit cards, like, share, and subscribe for more insights into money, financial literacy, and smart spending habits.